Welcome back, you legends. I'm Dr. Cal and let's get right into this video. So the stock market closed mostly flat with a slight pullback on the S&P 500 losing 0.3%, the NASDAQ closing flat, and the Dow Jones closing down 0.46%. Technology was the only sector closing in the green yesterday, consumer defensive and utilities closing flat, industrials, healthcare, and cyclicals closing slightly down on the day. Communication services closing 1% down, basic materials leading the losers with a whopping 3% decline, energy, financials, and real estate all getting hit really hard yesterday after the producer price index came in at a record 11% up year on year. Absolutely insane inflation. And on top of that, we had banks report really weak earnings, really weak guidance. So this looks like a full-on defensive risk-off move with technology, consumer defensive, and utilities leading. Really, the reason technology was leading was Apple. Apple lifted the entire sector up. Apple was up 2%. We also have semiconductors up on the day following that news from TSMC, which beat on both the top line and the bottom line. And in fact, the company raised its revenue forecast for the year. For those of you who don't know, TSMC is the largest chip maker on earth with the most advanced technology. They reported strong earnings and strong guidance, and the market liked that. Another pocket of green that we have here, guys, is consumer defensive with Walmart and Costco going up significantly on the day. Costco closing up 4% on the day. We also have Eli Lilly closing up and Boeing. So it does look like a full-on risk-off move. Let's take a look at the futures. As of right now, guys, it's 7 a.m. Eastern time, and we can see a trend here in the futures. We have oil and energy commodities moving significantly up in the futures market. We have muted action in the major indices. And there's a small trend that you can notice here where the Dow Jones is actually leading the NASDAQ. And that tends to happen when the dollar weakens because we see energy stocks move up and they end up outperforming the tech sector. We also have the Euro and German indices moving up. So we will see if the US stock market follows through on that. I would actually suspect that we won't, and here's the reason why. Now, on the daily chart for the S&P 500, we can see two pretty strong green candles, but you've got to remember here, guys, that we gapped down and then moved up. Then we gapped down again and moved up the second day. So on the chart, this might look like some strength, some buying pressure here, which would make sense. This is support. 373 on the S&P 500 is support. We actually undercut that level yesterday and then we pushed through. We had a really sizable rally from the open to the close. But then again, we had this really subtle change of trend towards the end of the day. I don't know if you caught it, but here it is. Look at that. We had a top right here, a higher high right here with a double top formation, but a lower high on the MACD. So we have a negative divergence, a higher high on the 5-minute chart, a lower high on the MACD, and this tends to indicate weakness. So it's a very subtle move, and it occurred right at that gap fill level. So I do expect a lot of shorting to take place here. Bears will defend this territory. They will want to push the price all the way down to $371. And remember, guys, we have a bunch of economic data coming out today. We have retail sales, 5-year inflation expectations, and the consumer sentiment index coming in. Okay, so on the daily chart, despite this pullback that we've seen, we're still in positive momentum on the MACD, but bear in mind, the MACD is curling down for a bearish crossover, and we have this double top right here with a lower high on the second top. We have failed to fill this gap twice now, which is very bearish in my opinion. We've broken through this support. It's been bought back up, but I suspect that if we break through again, bears will take full control and try to fill this gap right here at the $366 level, and then perhaps even push the stock market below this low to create a lower low on the daily chart. Now let's take a look at the triple Qs, the NASDAQ. Same thing really. However, the NASDAQ has been slightly outperforming the S&P 500. largely due to the declines that we've seen in the energy sector and oil, which has helped the tech sector slightly outperform the rest of the market. Again, we failed twice to fill this gap right here at the $300 level. We've made a higher low on the daily chart. Unlike the S&P 500 where we've actually made a lower low, we're sitting smack down in the middle of this descending channel. We've had significant selling occur at this blue line right here. We've had it once, twice, 3 times. Okay, so we've had so many reactions here. Sellers always step in towards this line right here. So if we do see the NASDAQ attempt another rally, we will probably see another rejection right here and a sell-off. My suspicion is that we will see selling today. On Friday, we just have so many negative catalysts coming in, and Friday the 15th of July has traditionally and historically been a really weak day for the stock market. Again, we have a double top right here with negative divergence on the MACD. We filled the gap on the NASDAQ. We might see one more push and then a sell-off, right? That would make sense. We might see a gap down, right? We might see the market open down somewhere around here. We might see a run towards a gap fill for a triple top right there, and then another negative divergence reading right over here, and then we might see the bears step in. Now let's jump into the daily chart for the IWM, the Russell 2000. The Russell 2000 is holding this level right here at the $167 level. We had a double top with a lower high on the second top. We're getting really close to a bearish crossover on the MACD. We failed to fill this gap right here. We've even failed to fill this lower gap right here. So this does not look bullish at all to me, right? It looks like we're flagging. This is the flag pole. The flag is waving and it's just waiting for a break of this bottom right here. Remember guys, we have earnings coming in throughout the rest of the month and through August as well. And if the bank earnings that we've seen from Morgan Stanley and JP Morgan are anything to go by, then we will see significant weakness in the earnings coming out this earnings season. Now let's jump into the daily chart for the dollar index. We've made a higher high yesterday right there, a shooting star candle. We're now seeing somewhat of a pullback. I would not be shorting the dollar index at these levels, right? Because we might end up just doodling here like we've seen back there. So there's a non-trivial possibility that we just doodle towards this upper edge right here, and this will put a lot of pressure on the stock market, right? If we see a pullback to the lower edge of this channel, I would be buying the dollar. Now let's jump into the daily chart of the VIX, the fear index, the volatility index. Really weird action on the VIX here, guys. We had a break below this support line right here, and then we pushed through it again, and now we're going back down, right? We have seen similar setups in the past right over here. Look at that. We've broken this support line, and then we popped, went back, retested, and then we had that massive crash right there. We did a similar thing right here, broke through this support line, popped up, retested again, popped up again, retested, and then we had a crash. Right, so we could see some weirdness happen here, guys. It's earnings season, really anything could happen. Volatility is sitting at really low levels here. We also have the put to call ratio still moving up, which indicates a lot more selling coming our way. And remember guys, the put to call ratio has made a significant move up and the VIX hasn't, right? The VIX has just been moving sideways here. So if we see a pop in the VIX, we will see a very significant sell-off, okay? Keep in mind, guys, we went from 390 on the S&P 500 all the way down to 371, okay? We took 5% off the S&P 500 and the VIX barely moved, right? It barely budged. So imagine if we see a really strong spike in the VIX, we will see a very, very big sell-off in the S&P 500, much bigger than what we've seen so far. Now let's jump into JP Morgan. JP Morgan reported earnings. They missed on both revenues and profit, and they provided weak guidance. They've also shelved their plans to buy back stocks. So this is very, very negative, okay? And financials tend proven to be a leading indicator in what's happening in the economy and the stock market. Look at this absolutely insane decline in JP Morgan. JP Morgan is the largest bank in the US, and we have already seen it lose 37% from its 2021 highs. As the economy weakens and as interest rates keep rising and as the inversion in the yield curve gets worse and worse, we could easily see banks undercut the 2020 lows. Now let's talk about Apple. Apple has been outperforming the market remarkably. Despite the significant selling we've seen in the week, Apple has actually been putting a higher high as the stock market has been putting in lower lows. This is really typical of Apple trading. It's been trading a lot like a defensive. In fact, if you go and watch any of the network news channels, you will see pundits talking about Apple as a defensive, right? Everybody's been buying Apple, and when you see so many traders pile into a single trade, it becomes really crowded, right? Since everybody's been in Apple and has been holding Apple and buying Apple, there are a lot of people that could start selling Apple, right? And we are hitting a really critical level here at the very top end of this descending channel that I've drawn up. This reminds me a lot of our top back towards the end of March right here, where Apple formed a double top right over there. And on the 4-hour chart, we actually had negative divergence, right, with a lower high on the MACD. We have somewhat of a similar look today, right? We have a lower high on the MACD on the 2-hour chart, and we've been making higher highs. So momentum has been weakening at the very top, and when you see momentum weaken, like we've seen right here, that double top and negative divergence on the MACD, we tend to see selling start, right? And this is very typical of Apple. Apple will hold up, outperform the market. As we're seeing selling in the S&P 500 and all major indices, Apple will hold up, and then eventually it breaks down, right? So I'm definitely eyeing Apple for a short position. I do think there's possibly a nice little trade here. Now let's take a look at Google. Google's been really interesting. We've been making higher lows on the daily chart. We've been coiling for a while now, making slightly higher highs, but not really. We've been hitting this resistance right here at the $2,390 level. We have the split coming up next week on the 18th, and my suspicion is as soon as we see this split take place and completed, we will see significant weakness in Google. We've talked about this massive bear flag here. We've talked about the full measured move for this bear flag, taking us all the way down to $1,700 towards this cluster right here. And we do have catalysts coming in the form of earnings in the next couple of weeks. Now let's take a look at the semiconductor index. The semiconductor index has been actually doing really well here, outperforming the rest of the technology sector, primarily because we've had this significant weakness here. So it's just regaining some of that lost strength, but eventually we will see a hit of this 50 period moving average, or perhaps the edge of this resistance channel, and then we will see selling continue in the semiconductor index. This is a ratio chart of the semiconductor index divided by the NASDAQ. We're seeing this nice bounce in the relative strength right after we had this massive weakness. So this is to be expected, but keep in mind, we do have more semiconductor earnings coming in towards the end of the month. So we might see this relative strength continue right up until those earnings start coming out, and then we see selling pick up again. This is TSMC, the largest chip manufacturer in the world. They reported really strong earnings, really nice guidance, but they also cautioned on large customers like Apple, AMD, and Nvidia cutting back orders for 2023 as they start to work through their current inventory levels. Remember that crash in the crypto market has a direct effect on semiconductors because people buy chips, GPUs specifically from both AMD and Nvidia to mine cryptocurrencies. So when cryptocurrencies crash, people stop buying these GPUs, a lot of miners start selling their farms, and you get this massive surge in the second hand market. We also start to see demand waning, so we have this double effect, right? Where inventories are rising and demand is declining. And so companies like AMD and Nvidia have no choice but to cut their chip orders from TSMC. So the strength in TSMC combined with this rebound in semiconductors is going to probably fuel a continuation of this relative strength in the semiconductor index and semiconductor stocks right up until we start seeing more earnings from AMD, Nvidia, and so on. And even if they report really good earnings, I do suspect that the market will sell those stocks regardless, right? Because of the supply-demand dynamics that I just talked about. Now let's take a look at gold. Gold is sitting at a really critical level right here at the $158 level, right? We've had a double test in the past here with positive divergence on the MACD. So I would definitely wait for gold to start forming a bottom, right? We might see a double bottom. We might see a head and shoulders formation, something like that. Right, I do need to see more structure on gold before going back in, but we could definitely see gold rebound if the dollar cools down, and that could lead to really massive rallies in gold, right? We just have to wait for more structure on the daily chart and the momentum indicators. Now let's take a look at AMC, our buddy, our friend AMC right here. We had a double rejection, right? Those are rejection candles where we rally up and then reverse and close towards the bottom end of the day. So we have a really long wick to the top, another really long wick to the top the prior day. The way to read these candles, guys, is that the wicks point toward the areas of rejection. So we're rejecting prices right here, and that in turn means that we will probably see selling, right? So just like there, rejection, sold off, rejection, sold off, rejection, sold off, right? That's how you would read those candlesticks. Another example is right here, rejection, sold, here as well, massive rejection, sold off, massive rejection, sold off. So that's how you would read those candles. Typically, if you find them at the top of a trend, it means that the trend will reverse to the downside, right? Now on GME, GameStop, same thing really, a massive rejection candle today. We've had several rejections of this level right here, once, twice, 3 times, and 4 times. So we've just been rejecting consistently. We're just waiting for that split to take place on the 22nd of July. And as we get the split out of the way, I do suspect that GameStop will sell off significantly. We have Tesla. Tesla has been tightening more and more. We've been wedging, right? We have this pennant forming on the daily chart. We had a breakout right here and then a rejection. So this is a false break. And what tends to happen, guys, when we see a false break toward a specific direction, so if the false break was towards the bullish side, we tend to see a selling follow that. If we see a false break towards the bearish side, we would typically see buying after that. Again, this looks like a massive bear pennant on Tesla that's just waiting for a break and then a waterfall sell-off to follow. And we've talked about this. The longer the price continues to tighten, the larger the move afterwards is. Now let's take a look at CNN's Fear and Greed Index, where the reading is 24 for the day, which reads extreme fear. But keep in mind, guys, we've seen this reading go all the way down to 6 and 5 on really strong selling this past year. Momentum is weakening. Price strength is trying to pick up, okay, as breadth is declining. And when you see a massive decline in the stock market breadth like so, this tends to filter over to really big stocks like Apple, Google, Amazon, etc. They try to hold up their levels for a while as the rest of the market declines, but they eventually fail. And that takes us back to the discussion about Apple showing really strong movements to the upside as the market is declining, but this will eventually fail, okay? And when it fails, the sell-off will be very violent, just like what we've had from the March top to the May bottom, okay? I do suspect that a similar sell-off will take place in Apple that will take us to a new low by September. And as we've mentioned early on in the video, put to call ratio still moving up. We haven't taken down this high right here. We've been in a positive uptrend on the put to call ratio with consecutive higher lows, right? And this is a really big red flag that selling will continue. Despite the fact that the put to call ratio is rising, we have volatility just chugging along, right? In a setup that looks really similar to what we had back here in January. We had volatility just move sideways, and look at that. And on January the 10th, VIX was below 20 while the put to call ratio was rising, right? Look at that. This looks a lot like what we're seeing right now. Volatility just moving sideways, put to call ratio is leading, and volatility will soon follow to the upside. Today we have retail sales coming in really soon. We also have consumer sentiment index and the 5-year inflation expectations. So we could see really significant selling in the stock market today if retail sales come in below expectations and if the consumer sentiment registers a new low, right? Last month we had the lowest reading on consumer sentiment in the history of the consumer sentiment survey. So be careful out there, guys. That's all I have for you today. Thank you so much for watching, liking, and subbing. You are absolute legends. Thank you, and I'll catch you in the next one. Bye-bye.
Oh, wow.